you for joining us here today. This is Mike Maloney with IFC National Marketing. I am the Regional Sales Director for Life, Long-Term Care, and Disability Insurance here at IFC. Wanted to take a moment this morning to thank you so much for joining us today for the webinar and to take time out of your busy schedule. We know how difficult it is sometimes to free up time to do this, so we certainly do appreciate that. A couple of housekeeping items. You will be muted throughout the entire broadcast, but if you do have questions, if you put them into the questions box, which is part of the program here, we will address all of those either as we go or at the end. But without further ado, I wanted to introduce to you from Prudential, Vicente Pina is joining us today. He is the Business Growth and Marketing Expansions Director for Advanced Planning in the Individual Life Series, Life Insurance for Prudential. I'm going to let Vicente give a little bit of background on himself and let him go ahead and get started. So with that, Vicente, take it away.
Thank you, Mike, and thank you all for making the time today. I really appreciate it. As Mike said, we know you're busy, so let's kind of get right into it. Hopefully today will help you in your practice and ultimately help your clients in terms of their pursuit, particularly as we talk about retirement. As Mike said, my name is Vicente Pina. I'm a director on Prudential's Individual Life Insurance Advanced Planning team. I joined the industry in August of 1989 with Prudential as a Prudential advisor, and then eventually worked in the home offices of obviously the Prudential, but prior to that, I worked in the home office of the Hartford, and some of you may even remember Connecticut Mutual. For a number of years, I worked overseas in our industry, worked in Asia and Latin America, and I've been back here in the US for about 20 years now. So let's get right into it. The Advanced Planning team has a brand new presentation that just came out last Thursday. So I'm going to guess most of you, if not all of you, have not seen this. So it's a great presentation. If you need a copy of it, Mike or Wade Huber can get it to you. So let's get right into it. So this presentation, the retirement client, really is all about the retirement gap that we all know, everyone on this call knows about. Some of you know people who are in retirement, but essentially a recent publication by Ernst & Young, the accounting and consulting firm, estimated that by 2050, there'll be a $483 trillion retirement savings gap and a $240 trillion protection gap. Now, as we, those of us in the financial services industry, we need to step up to help clients close these gaps and achieve financial security. It's a time to look at the product tools that we have at our disposal and think about the ways in which we can help clients achieve their desired outcomes. I just read an article this morning for one on the call, Yahoo Finance, and there was a letter to the editor, kind of like a Dear Abby, and basically saying this sister and brother have no money, but their mom is a multimillionaire, and they're like, why is mom spending all of her retirement when she can give it to us? I mean, it's a very kind of telling kind of comment. Clearly, the kids are not saving, and those in retirement right now have saved, but looking forward, these folks like this brother and sister that wrote this article, the Yahoo Finance, they're clearly not ready for retirement because they have no savings. So let's get right into it. The numbers we just highlighted are big numbers, which can sometimes make it difficult to wrap our minds around the size and the scope of the retirement savings and protection gap. With numbers that large, it's likely that most clients have a gap of some size, even those clients who may feel pretty comfortable. If you're not providing comprehensive planning and wealth management services, you risk clients leaving your practice to find them elsewhere. They're going to go to other advisors who don't have the things that you're looking for or don't address the needs that they have. Increasing your practice to include comprehensive financial services offer benefits that include, as you can see here on the screen, we have clients, 87% of clients globally feel confident about covering their essential retirement expenses, but only 41% have a written plan. Most people, it's in their head. It's really not something that they've actually expressed or put to paper. And only 25% have a clear withdrawal strategy. Now, it's time to think more holistically about planning. The industry has been steadily evolving over the past decade, and now more than ever, clients are relying on financial professionals like those on this call today to help them develop and manage a plan that's customized to their goals. More than half of clients now find it important to have a written financial plan. If you're not providing comprehensive planning and wealth management services, you risk your clients leaving your practice, as I said, to find them elsewhere. Increasing your practice to include comprehensive services other than benefits include what we see here on the screen. Stronger client relationships, right? Because you have this multi-line relationship. Increase client retention, right? They're not going to go to another advisor if they have the bulk of their needs addressed with you. Of course, that means increased client wallet share. And when they're comfortable and they know everything that you can do, along with the help of IFC, they're going to more likely give you professional referrals. They may not even refer people to you now because they think this is something that's outside of your practice. Increased differentiation, obviously, if you're competing just against firms that only offer one product or address one need, you can differentiate yourself. And obviously, there's a flexibility to move more upmarket with clients with more assets. You can see here, according to a survey in 2024 Q2, 53% of households find it important to have a written financial plan. That's up from 41% just 10 years prior. Don't forget, if you have any questions, as Mike mentioned, put them in the questions box and we'll get them during the course of the presentation. So let's look at, as you start thinking about a client's holistic plan, it's important to help clients consider each product offering through that same lens. For way too long now, life insurance has been viewed almost as an outsider or even a detractor from a client's overall plan, taking away from the assets that you have under management or the products you're already managing. We need to challenge that assumption and start thinking of life insurance as both an asset class and one essential component as part of a client's full financial picture. So you can see here on the left, many advisors look at life insurance as kind of out there on its own, like a planet in a circling or moon circling another planet. And here we're actually saying on the right that life insurance should be part of every plan. So the retirement climb is the name of the presentation, as you know, and we're going to really focus on these three things here. If you spent any time in your career helping clients plan for their future retirement, you know that planning involves more than just a few conversations and the purchase of a product. It's a journey rather than a climb. As you can see, to help clients successfully plan, we must help them plan while they ascend the mountain, accumulating assets. But then also we need to help them descend the mountain during their decumulation years. So during our time together today, we're going to discuss climbing up the mountain. We're going to talk about different paths coming down the mountain. And then lastly, we'll try to wrap up with a case study showing how life insurance can offer clients unmatched flexibility forever life throws their way on either side of the mountain. So let's talk about up the mountain, accumulation years. For most clients, the importance of accumulation or pre-retirement savings years is well known and understood. I think most people know they have to save for retirement. But 89% of the mass affluent individuals are motivated to prepare for the future they envision for themselves, making the conversation about accumulation more welcoming and opening. This is a key point takeaway. The accumulation years going up the mountain, their ears tend to perk up, the mass affluent, when we're talking about a future based on accumulating enough assets so they can have a comfortable retirement. So let's start at the base here. Every client needs to start at the beginning, the base of the mountain, so to speak. For many clients, but especially younger clients, their income over the course of their working years will be one of the biggest assets they have, both to live on currently and as a basis for what they save in retirement. Helping clients understand the true value of their salary by showcasing them what the money could be over 15, 20, 30, or 40 years. You can see here on this chart, someone making $200,000 a year, over 40 years, they're going to make million in salary, right? If they're making $150,000 a year, they're going to make well over 2 million, by year 30, and way over 2.7 million by year 40. Or even if you're making $100,000 a year and you have 20, 30, 40 years of retirement, you're going to have over $1 million. These folks who make $100,000 a year don't consider themselves to be very wealthy, but obviously over a 20, 30, or 4-year period, they're going to have more than $1 million. So that's where they need your help, how to allocate some of those funds to retirement. Now, protecting a client's future income starts by identifying this protection gap through a simple calculation. Their potential income until retirement minus their current life insurance coverage. That should reveal the amount of money a family will need to replace in terms of lost income should something happen to them during their working years. Addressing this need is the primary purpose of life insurance. A life insurance policy protects families from the financial burden of losing a loved one prior to retirement, and it helps pay those benefits to the beneficiaries that can be used to complete those goals, like staying in the family house, not having to move out, or having to quit college, or go to a lesser a college, or perhaps leave college altogether and have to work. And even retirement goals like, I want to retire at a certain age, based on what I'm contributing. Even though life insurance is first and foremost a protection product, if you're only considering it through this lens, you're not unlocking the full potential as part of a holistic plan, and missing opportunities where the right type of life insurance policy can help address multiple client needs, such as offering protection and helping a client live the retirement of their dreams. Now, this slide should be no particular surprise to anybody on this call. Where are people saving for retirement? You see here that the most common is probably a 401k if you work in the for-profit or commercial sector, 403b if you work in the nonprofit sector. Of course, IRAs for many folks who are self-employed, Roth IRAs for those people that qualify or can convert to a Roth IRA. Some people save money in their traditional brokerage account, which usually is non-qualified, and that means you're paying taxes on your growth every year. Savings accounts, I guess conceivably you could save in your bank account for retirement. That's probably not the best way. And then other folks have health savings account that can obviously help pick up those things that health insurance may not pick up on. Now then, the question is, for those clients who are saving, this is another big takeaway. Are they diversifying their sources of income? What we're really talking about here is tax diversification. We're not talking about asset diversification like you typically would be with like investments. This is a real educational opportunity, as this strategy can help clients better manage their tax liability in retirement, including vehicles from these 3 buckets you see on the screen here. From left to right, you see the tax deferred accounts. We mentioned the IRA, and there's obviously SEP IRAs and simple IRAs for many self-employed business owners and their employees. We talked about the 401k, 403b, even annuities, as we all know, grow tax deferred. So when you have all your money in that bucket on the left, that basically means all your retirement income is going to be taxable. And so there are many people out there who think that their taxes are going to go down in retirement, but that may not be the case if everything you're living on is taxable, including what's not even here is Social Security. In the middle, you have taxable accounts, which we talked about, like your brokerage account that may hold stocks or bonds or money market cash. They may even have mutual funds in there, and those you're getting taxed on every year. And then on the right, we have tax-free accounts. And of course, municipal bonds are very common. Certainly, we talked about the Roth and Roth conversion and Roth IRAs. But remember, the traditional Roth IRA is capped in terms of how much your ability to put in and how much you can put in, but certainly the ability to put in at certain income levels. So if you have a client that's making a good salary, a high income salary, they may not even qualify for a traditional Roth. They may be able to do a Roth conversion, but then they're going to still pay the tax on the conversion. But one of the big things that most people aren't aware of, or the power of it, is the cash value of life insurance is tax-free. So we're going to talk a little bit more about that later. And of course, we mentioned the health savings accounts as well. So in terms of creating income with a life insurance policy, how does that happen? Well, as I mentioned on the last slide, life insurance is one of the few vehicles a client can potentially provide tax-free income in retirement. For clients who've never considered life insurance beyond just protection, just beyond term life insurance, they'll need to understand how a policy can generate income, how a permanent life insurance policy can generate income. This happens when a client purchases a specific type of policy and maximizes the premiums paid into it, allowing the cash value to build over time. And then during retirement, clients can access this built-up cash value through loans and withdrawals up to basis as a source of income. At death, a client's beneficiary or beneficiaries would then receive the death benefit minus any outstanding loans or withdrawals taken from the policy. There are a few keys for this strategy to be successful. One, as we mentioned earlier, includes proper funding of the policy, or what we often call in the industry overfunding the policy, and maximizing the contributions, but staying below the MEC limits, the modified endowment contract limits. And of course, having a conservative illustration as well can provide also at Prudential consistent policy management to see how the policy is doing as it's going along. Many of you might be familiar with our Life Insight tool, which accomplishes that. So you're able to actually see how the policy is doing as you're maximizing those premiums. The cash value is growing over time. You can see the projections as it's going, and you can see what the potential retirement income and also the death benefit in case you would die along the way. Now, as many of you know, there's a lot of old biases regarding life insurance. It's often an objection that you hear either from clients or advisors about purchasing a permanent life insurance policy, and the belief that maybe I could buy term and invest the difference and my money manager can beat the illustrated returns. However, for many clients that want to take that risk, or would they perhaps choose a life insurance policy if they knew it offered protection from the unknown? So here you see on the screen here a $750,000 death benefit on the left, which is the FlexGuard life insurance IVUL product. And on the right, you've got kind of the buy term invest the difference, the 30-year level term with a taxable alternative investment. You can see on the left with the life insurance, assuming a 7% gross rate of return allocated to the S&P 500 index fund, which many of you may be familiar with, and a 15% buffer, which means that it's going to absorb the 15% of negative growth on the downside. You're actually able to get $160,000 more than almost $160,500 of annual distributions of income, loans, and withdrawals beginning at age 65. So you could see here that buy terming invest the difference may seem like hypothetically a great idea, but don't forget taxes, because that side fund that they're investing in is taxable. So you could make all the money in the world on that taxable side investment, but those taxes are going to come out. And as we all know, taxes for many people are 30% or more. So let's talk a little bit about these old biases. We know what the average rate of return on their investments, but it's a really bit of an unknown. The money manager, just like any other financial advisor, doesn't know what the rate of return will be in the future. What about the sequence of returns of those investments? I think about the people who retired in 2008 when the market went down, or for those who've been around a while that went down in 2001. All these times that there are corrections, people have plans to retire, and then all of a sudden they're retiring on much less amount of money because the sequence of returns, they picked a year perhaps to retire where the market went down. What's going to be the tax environment when a client retires? We see that the government's spending lots of money right now, and we all know that we have a deficit. How are we going to pay for that? Everyone on this call and all Americans are going to have to pay for that. And then, of course, what happens when a client dies along the way? They've got this grand plan to buy term and invest the difference, but then they die along the way. So perhaps those taxable investments wouldn't have grown because obviously once you die, you're unable to contribute to those investments. Now, we've talked a lot about accumulation. Now we're going to spend the second portion of our time together just on decumulation. Basically, there's only one way up the mountain, as we talked about, saving for retirement, but there's multiple ways to come down the mountain, and that's what we're going to talk about next. So one is the potential to live too long. We all know people are living longer. I know my dad, he retired at 56, he died at age 96, 30 years. Most people don't have 30 years worth of retirement income, and certainly he did not as well. The number of Americans over 80 is probably the fastest growing segment of the population, and about 40% of those people will face financial instability as they age. So that's another reason why diversifying the retirement savings is because they're going to need more money in retirement, in all likelihood more than just one account can deliver. Longevity obviously multiplies risk. You could outlive your retirement. We talked about bear markets or markets going down. And what about inflation? Certainly, healthcare costs are at the top of most Americans' minds, particularly retirees and pre-retirees. What's it going to cost? And what happens if they're diagnosed with a chronic illness? Now, when we're talking about life insurance addressing longevity, it certainly can take advantage at different phases. At the beginning of your retirement journey, a client could choose to receive retirement income from a life insurance policy to allow them to delay Social Security. Remember, life insurance cash value doesn't have the 59.5, 10% penalty rules. So if they just say, hey, listen, I wanted to, maybe take Social Security at 62, maybe I could take it at 70, but I'll live off of the life insurance cash value in the meantime, say between 60 and 70. In the middle of their retirement journey, a client could tap into life insurance to provide income during a bear market, enabling them to not take money out of their retirement. Again, imagine retiring when the market's going down, but you have committed to it. Well, perhaps you can use this life insurance cash value to weather the storm. And then at the end of your retirement, life insurance could provide an additional source of income in those later years when traditional assets are becoming close to exhausted. What about dying too soon? That's another risk. How about the surviving spouse? The gap in life expectancy between men and women is the largest it's been in over 25 years. I know this myself. My dad died in 2009, and so it's 16 years, and my mom is still alive. Nearly half of widows outlive their husbands by 15 years. Where's that income coming from? We all know that they can't collect two Social Security, so where's that income coming from? There's a lot of financial strains of being a widow or a widower, including reduced income from the loss of earnings, or certainly the loss of one of those Social Security paychecks. You may have a change in your filing status from a tax perspective because it reduces the standard deduction and narrows your tax bracket because there's only one of you now versus two of you. And it increases the likelihood of paying higher taxes on lower income. Now, how does life insurance protect the surviving spouse? Well, the decedent's policy, say they'll just assume the husband were to die. Upon the death of that first spouse, the surviving spouse receives that death benefit income tax-free. Imagine receiving $1 million income tax-free death benefit versus $1 million IRA. Well, we know that IRA, 30% of it's going to go to the government, if not more, in income taxes. And they can use this tax-free death benefit as a source of funds to pay those final debts, expenses, but also a source to live on. The surviving spouse, the widow or widower, can use those living benefits on their own policy. And of course, if they have their own policy, they can tap into the cash value of that policy to offset any ongoing loss of income by the loss of the first spouse. And the last thing we're going to talk about is just getting sick along the way. What this really means is most of us will need some type of care after 65. Frankly, there's a statistic out there from the Department of Health and Human Services that someone turning 65 today has a 70% chance of needing long-term care services. I don't think that should be a surprise to anyone on this call, but the cost of health care for a 65-year-old individual may need $165,000 in after-tax savings to cover healthcare expenses. That shouldn't be a surprise to anybody on this call, because, of course, the cost of healthcare both in the home and outside of the home is rising every day. And lifestyle risk, chronic conditions like diabetes and high blood pressure increase the need and the demand for long-term care insurance. As we wrap up here, we're just going to talk a little bit about chronically ill in retirement. Most of you know, perhaps from your background, that chronic illness, unable to do 2 of the ADLs here on the right, excuse me, or being required substantial supervision to protect such individual from threats to health and safety due to severe cognitive impairment. Now, this is where life insurance can come into play, because many of us are not aware that life insurance not only has a death benefit and cash value that we talked about earlier, but we do have this thing called a chronic illness or terminal illness protection known as the Benefit Access Rider, or BAR, here at Prudential. That Benefit Access Rider allows you easy access to cash. It can also, you don't need any receipts or restrictions. It's not one of these reimbursements model. You're essentially accelerating the death benefit while you're alive, because you can't do 2 of the 6 ADLs, which is the most typical way to qualify. All your life insurance premiums are waived. That policy, no more premiums when you're on BAR claim. And of course, we provide a concierge care service for policy owners, family members, and caregivers that will have access to complementary resources and to navigate the chronic and terminal illness care process. So we have a dedicated unit to help families go through this. So I wanted to just take a quick moment and see any questions so far, Mike, in the chat.
Hey, this is Don. No questions so far. Hang on one second. Yep, nothing so far. Let's see. Are you going to go into this? Do you have any more slides to go through there, Vicente?
I'm just going to quickly go through a couple and then I'll wrap up. How's that?
Okay, perfect. Yeah, go ahead. That'd be great.
Just going to wrap up with a case study, because I think a case study really puts it into practice. So let's imagine you've got a client who you think qualifies for this, and maybe you're trying to figure out what kind of product. And of course, the IFC support team is great. They can help you with this. But let's say you're the kind of person, or the client's the kind of person that is comfortable in participating in the market in terms of the stock market return, the bond market returns. So obviously there's ups and downs. You can see, you could go up and you can go down. Other people in the middle are, well, they're perhaps, a little bit more conservative, and they don't want to maybe experience the volatility. I can remember my mom had a variable annuity for a while, and the ups and downs were just not for her. So, of course, put her into something that is far more narrow, less aggressive. And so here you can capture some market growth up to a cap, and it also absorbs on the buffer some of the downside. So we have products like that as well. And the third type of product that we have is where you basically have a 0% floor. The company is essentially going to absorb the downturns in the market for you, but there'll be a cap on the growth. So perhaps instead of the market might be earning 12, you might be earning 8, or maybe the market did 10 and you're going to earn 7. But on the downside, if the market does -7, you're not going to get -7 rate of return. So we have these 3 type of products. Many of you know this as VUL on the left. I would say your traditional IUL might be on the right. And then we have probably our IVUL or index VUL would be somewhere kind of there in the middle. So we have a client here, a married gentleman named Andrew. His wife is an attorney. He's a self-employed business owner, a couple of kids. They're making good money. They're maximizing what they're putting into a 401k. They want to retire at 65, and they have some toleration for variable investing. You can see here the different kind of scenarios we talked about. If they live too long, you've got the different bar graphs here. The dark is the premiums they paid. The blue is the cash value at 65. The green is the distributions. Remember, we talked about taking money out at 65. And then the gold is the death benefit that passes to the wife and the children. In this particular case, if they die too soon, you still see the premiums and cash value are the same, but there's not going to be any of those green distributions, right? Because I died too soon, and the death benefit of $5 million goes to my wife and kids. And then lastly, if I get sick along the way, you got the death benefit on the right, which again is going to be affected by some of the distribution. Say I went on bar claim, the benefit access rider, that would be reflected in the green. Maybe I took some income as well, but certainly the cash value is the same and the premiums are the same. So in essence, the client's able to get a benefit out of this policy regardless of living too long, dying too soon, or getting sick along the way. You might be asking yourself, what about poor performance? Of course, if it's a 0% performance, you still have the death benefit guaranteed to 85, but of course there'd be very little cash value and the policy would lapse. So certainly clients who want this type of policy, part of the financial advisor's responsibility along with IFC is to manage that, and perhaps putting it in the proper and the correct sub accounts, just like at your 401k at your job. Perhaps they're more conservative, you put them in the more conservative sub accounts, or in the case of Prudential, we have an indexed account and an indexed product, so it can absorb some of that downside that we talked about earlier. So just a final thought here. Life insurance is part of a holistic financial plan, provides clients with control and, even more importantly, flexibility that they can use at any time during their life. Going up the mountain or down the mountain, they can navigate any path, and they can protect against living too long, taxes, market volatility. You, as the financial advisor, increase your value to the clients by offering comprehensive planning that includes life insurance. And lastly, improve the probability that the client's plan will achieve a better outcome. There's nothing better than a client saying, you help me make my plan a reality. So with that, Don, I'm going to turn things back over to you, see if there's any questions.
All right, thanks, Vicente. Again, everybody that's on the call here, my name is Don. I am the insurance concierge here at IFC National Marketing. So yeah, if you like what you see here, Mike is going to be on here in a second. If you like what you see, or if you feel that this is a little bit maybe outside of your wheelhouse, feel free to reach out to me here at IFC National Marketing, and I'll definitely help you, teach you a little bit more about this particular concept, or even help you sell the cases as well. But right now, let's bring Mike back on to wrap things up. And let's see, there is one question here. Will the information be sent out to the attendees? Yes, absolutely, definitely, it will. So perfect. But any other questions, feel free to put it in the questions box. And I guess, Mike, if you can hear me, you can go ahead, wrap up, because I don't see any other questions. And I can't hear you, Mike.
Thank you so much, Vicente, for taking the time today to join us, and Don as well. Thank you, everyone, for staying around here and seeing this. If you guys have any questions, please don't hesitate to reach out to us. The number 800-598-5560, and I'm Mike Maloney. My internal is Wade Huber. And Don, we would all be able to field any questions that you may have on the presentation for today. And yes, it will be sent out. And then secondarily, wanted to just take a minute to reiterate what Don had said. Don is our concierge director. So if you guys are a little uncomfortable, or maybe don't have the time to take care of something on the life LTC or DI side, by all means, employ Don, get a hold of Don. He will do this. He'll jump on and he'll take care of it for you. Otherwise, if it's something that you're comfortable trying to do or wanting to do, Wade and I can help you get through that as well. So with that, I appreciate your time today, everyone. Thank you so much, and I hope you have a great rest of your afternoon. Bye-bye now.
Thank you.